Hello, welcome to the monetary policy chapter. Notice that this chapter doesn't have a number because it is not contained in your textbook. However, the MBA program requires that you learn the basics of monetary policy. So we will achieve this by using the free online material available at amosweb.com. Check the for further study clips so you can learn how to navigate to this online material. Okay, let's start. Fundamentally, monetary policy is the control over the money supply and interest rates by a central bank or monetary authority. In the United States, our country, monetary policy is undertaken by the Federal Reserve System, or the Fed for short, which is our nation's central bank. Money supply is the quantity of money that circulates in the economy. That includes coins, bills, checks, credit cards, and other monetary assets. The main goal of monetary policy is controlling the quantity of money in circulation for the purpose of stabilizing the business cycle and reducing the problems of unemployment and inflation. Let's take a closer look at these three main macroeconomic goals. First, full employment is attained when all available resources, especially labor, willing and able to engage in production, are producing goods and services. Second, stability is attained when fluctuations in prices, production, and employment have been eliminated. That's the economy is stable. And third, economic growth is attained when the production capacity of the economy increases over time, which is achieved by increasing the quantity and or the quality of resources. Therefore, monetary policy aims at making sure that all resources are fully used, that this happens within a stable macroeconomic environment, and that gross domestic product or GDP grows. Now, the Fed has three main tools to achieve these goals. Number one, the most important and widely used tool is open market operations, which is when the Fed buys and sells U.S. Treasury securities. That's Treasury bills, Treasury bonds, and other financial federal instruments. This buying and selling affects the amount of reserves that banks have available to make loans and to create money. Number two, the Fed can also adjust the interest rate that it charges banks from borrowing reserves, which is called the discount rate. Not very often used, but it's available. And number three, the Fed can directly adjust the proportion of reserves that banks must keep to back outstanding deposits. Again, it's not a very frequently used tool, but it's available as well. All three tools affect the money creation process undertaken by banks, and therefore, in theory, can be used to change the quantity of money in circulation. Now, the Fed essentially has three targets that are used to evaluate the effectiveness of monetary policy. First, the federal funds rate, which is the interest rate at which banks borrow from each other. Second, monetary aggregates, which is basically a collection of this term M1, M2, and M3, which are basically monetary aggregates. And you can check Amos Web to see definitions of these M1, M2, and M3. And third, exchange rates, which are the prices of one nation's currency in terms of the currencies of other nations. Now, current monetary policy typically works with a mix of targets, keeping an eye on interest rate, monetary aggregates, and exchange rates at the same time. However, in years past, it was common practice to pursue one target exclusively. For example, to implement whatever monetary policy was needed to effectively fix the federal funds rate at a constant value, even though doing so might cause some volatility for the monetary aggregates and in some cases also the exchange rates. As mentioned earlier, open market operations is the most common tool to control money supply. More specifically, an increase in the money supply is achieved when the Fed buys securities, since it gives banks money in exchange of the securities. In contrast, a decrease in the money supply is achieved when the Fed sells securities, since it takes money away from banks in exchange of the same securities. So the Fed is selling and buying, and that's how it regulates the money supply. The Federal Open Market Committee, FOMC for short, is the arm in charge of the Federal Reserve of these open market operations. One key question to understand how changes in the money supply have an impact on the economy is how the money supply it has an impact on the economy. So the answer depends on whether the goal is to stimulate or to put a brace to the economy. You want to stimulate or to make sure it doesn't grow that fast. The policy to counter a recession, and this is called expansionary, takes place when the Federal Reserve increases the money supply and lowers interest rates. In contrast, the policy to counter inflation, to keep the economy from growing fast, it's called contractionary and takes place when the Federal Reserve decreases the money supply and raises the interest rates. Check the For Further Study section to see examples of these cases. Of course, we cannot finish even a brief discussion of monetary policy without mentioning its linkages to politics. As you can see in this slide, in general, not always, but most frequently, conservative people and conservative politicians and policymakers tend to prefer tighter, contractionary tools on the money supply. Well, this keeps inflation rates down, even though higher unemployment rates may result. In contrast, and also in general, most of the times, liberals tend to prefer looser, expansionary use of the money supply. This, in contrast, ensures lower unemployment rates, even though higher inflation rates might result. Now, since this is a managerial econ class, not political economy, I want to leave it here. But the politics of monetary policy is a very interesting subject. Finally, it is important to mention the important relation between monetary and fiscal policy. When the federal government spends more money than it collects in taxes, then the government faces a deficit, a balanced deficit. This deficit is paid for by borrowing from the public, which is made possible through issuing treasury securities. And this is why US Treasury securities take center stage in the conduction of open market operations. As discussed before, the Federal Reserve exchanges bank reserves and Treasury securities as the primary means of controlling the money supply. And Treasury securities are used by the US Department of Treasury to raise funds needed to finance the federal deficit. Okay, this concludes the chapter, but make sure you check your amosweb.com section so that you learn more about these important concepts. Until the next and final chapter for this course.